Good morning, everybody. It's Wednesday, our Wednesday Live as usual, here on Instagram, answering your questions about the current state of the real estate market as well as the mortgage industry. As I'm waiting for my colleague David Gazarian from the IQ Mortgage to join me with the latest of the news on the mortgage industry, let's talk about the real estate market. First thing that needs to be mentioned as we come closer to the holiday season, the real estate market is going to slow down. As far as the sales are going to slow down, so do the rental properties. So if you guys have a rental property right now on the market, please do not be surprised that the average time on the market for the rental properties is approaching 50 days, which is extremely long for Las Vegas. We're usually our average is usually 3 weeks before we rent any kind of property. So for that reason, guys, please do not be shocked. Do not think that the sky is falling. It's just the average time on the market is increasing. The same thing is actually happening to the through the current sales. They're also extending the number of days on the market. Hi, David. How are you?
Good morning, Alexandra. How are you?
Doing great. I was just giving a little bit of an update for our listeners, talking about the fact that our days on the market are increasing, which is normal for the season because we're approaching the holiday season. It means that fewer people are willing to move throughout this timing. So you'll see fewer families willing to make the big moves right
That's
before
true.
Thanksgiving or Christmas. And when you can tell me that, wait a minute, Thanksgiving is not is months away, but this is exactly what it takes for a mortgage to be processed. So every time we're talking about the real estate transaction, we're talking 30 to 45 days in advance. But now that we have David with us on camera, I would like to torture David a little bit with the questions because we haven't seen you last week, so we collected some of the questions for you. And obviously, there is no news about the rates, correct? They're still extremely high.
No.
They're still dancing around 8%, correct?
They're over 8%. I know the national news say it's 7.9, and it's actually over 8%. And FHA high sevens. It's not low sevens. Anyway, so it's high sevens, above 8. It's as high as it's been since 1995.
Correct. So we're in the highest interest rates in the past 23 years. So let's talk about what we can do. Unfortunately, we cannot change the interest rates, but how can we increase the chances of possibilities? And one of the things that we've been discussing among the agents and what we see is the multi-generational living, when more and more of our clients are actually opting in for bigger homes just because they're looking to move in with their parents, or they're staying with their parents, or their parents are actually moving back in and occupying those either downstairs bedrooms, or they're looking for bigger homes so that people, like more family members, would have the room. So David, what do you see on the mortgage application? So is adding your parents to a mortgage application, could it be the way out for our clients, for our listeners, to actually improve their debt to income ratio, to add on to their creditability when they're purchasing the house? Can you please talk to us about it? Because as usual, at the tough times, we come back to our parents and we ask them for help. There's no better source than coming back to our parents. How does it work within the mortgage industry?
Absolutely, Alexandra. So since rates have gone up and payments have gone up, obviously affordability has dropped. This means that people that would have qualified, for example, a $450,000 home, now they qualify for a $300,000 home or a $250,000 home. Affordability has no doubt dropped. And yes, introducing someone else, and most often it is going to be a parent, with even their Social Security income. Our parents are smart enough not to, most parents, I should say, the older generation are smart enough. They haven't accumulated much debt. So quite often I see bringing in a mom or dad with Social Security income, and that changes the whole dynamic. Now there's more income on the loan application, and they do qualify for the loan that they're looking for. So absolutely.
And David, one of the responses that I could potentially see from our listeners is that, are you kidding me? There's no way I'm moving back in with my parents. So can you please elaborate if you're bringing your parent on the loan, do you actually have to have the parent occupy the property with you, or they don't necessarily have to occupy the property? Let's talk about this co-signer, co-borrower situation.
So they don't necessarily have to occupy it with you. That you could live in the house and your parents could live in a different house. Your parents could live in a different city. It doesn't matter. So as long as they have enough income to cover for their residence, let's say your mom lives in Los Angeles, she's got a house. Now she would have to have enough income to cover her own living situation, and then if she's got leftover income, she can help you with it. That's in case you don't want to move in with your parents and your parents have their own residence situation. They could be what's called a non-occupying co-borrower. They don't have to occupy with you. But in cases where families do not mind, and that's a different situation, they do move the parents in to use their income, yes.
Excellent, because a lot of times we find ourselves in these situations where parents, they might already have their residence paid off, so they don't have the mortgage. That's one thing.
That's perfect.
Another thing, when we just had a family where the parents moved and the parents started renting their residence in a different state. So not only they brought in their retirement income, they also brought in the
rental
income into the application, which tremendously helped. But David, can you please give us a little bit more of the scenarios where parents can help? Can parents help us on the loans with the down payments?
Absolutely. Parents, doesn't matter whether it's a parent or a brother, anyone that comes in to live or to apply with you, there's, instead of one application, now you have two applications. And yes, absolutely, they could contribute with the down payment. They could contribute with the income. The only thing they can contribute with is the credit score. So we are going to use the lower of the two credit scores. Other than that, they can contribute with everything, yes.
So that's and I think this is a very important aspect to discuss and to talk about. So if it happens so that your parent has low credit or bad credit, it might not be that beneficial for you to add them to the application, correct? You might be considering something like a gift from them and not necessarily putting them onto the application.
Alexandra, can I confirm that you can see me? Because my screen just timed off.
We can see you, but you're frozen. We can hear you, but your picture is frozen.
Okay, hold on. Excuse me 1 second.
You're good. So because we have multiple borrowers, we have multiple families with various life situations. So guys, before you decide on the approach or jump in with the approach, obviously you need to have the lender to check on the credit scores and to check would it be beneficial for for you to add the parent and how to add the parent. Not every loan will allow you to add the parent. For example, VA loans are very strict on who you can add to the loan. And so you need to be very careful with it, and you need to consult with the professional, and I mean the mortgage broker or the loan officer. You need to consult with them properly to know what is the most beneficial scenario for you and your family in order to get the loan. Sorry guys, trying to get, there we go. David?
I got Android. I'm sorry. Android is complicated.
You're good. You're good. So, David, can you please tell us in which situations it would be more beneficial to have a parent as the co-applicant, or in which situations it is like sometimes it is better just to take a gift from them towards the down payment and not put the parent as a part of your application? And I already mentioned that the VA loans, they are way stricter than other loans, so it's not like you can bring any type of a co-borrower with you onto the VA loan application.
So VA applications we can talk about separately, but when it comes to the most popular ones, which is going to be conventional FHA loans, if your parent's only going to contribute with a down payment, so to speak, then you could just get a gift. Then there's no reason to make someone responsible for the loan, make sure it shows on their credit, have them sign a deed and a note. There's no reason for that if all they're contributing is the down payment or closing costs. It could just be a gift letter. That's granted you're buying owner-occupied home or second home. If you're buying an investment home, there are no gifts for investment homes. Then you're going to have to bring that person in as a co-borrower, and they will be an applicant on that loan. That's for assets, right? If credit is low, then you're not going to bring that person in at all. If that person's credit is so low that you don't qualify, or that person's credit is so low where now your rate goes up significantly, then you may choose not to involve that person at all, and that happens quite often. The only really reason you would bring a co-borrower in is if you need their income. So we're going to fill out an application for them. We're going to look at their debts and liabilities and what they pay for their cars and credit cards and their residence. And hopefully they have a situation where their home is paid off, so they don't have a residence expense. So all of their income will be contributed to your qualification to help your DTI.
Excellent. And when we're talking about the co-signers or co-borrowers, is there a difference between a co-signer and a co-borrower?
The same thing. It's a co-borrower. Co-signer is not a mortgage term, really. People use it. I use it just to kind of get the message across, but there's no difference, no.
So it is a co-borrower. So when we're talking about the co-borrower, does the co-borrower necessarily have to be a relative, or it could be your friend, it could be your like distant cousin, it could be somebody that you really trust? Like, talk to me, who can possibly be a co-borrower with you?
Okay, so when it comes to FHAs and VAs, they're going to be stricter. It's going to have to be some sort of relative. Conventional is different because conventional also allows for investment properties. If you're buying an investment property, obviously it makes sense that you're not related. It's a business, so you don't have to be related to the person that's co-signing with you. So conventional is different. And it could be a cousin or not even zero relationship, a friend, so to speak. But when it comes to VA and FHA, there has to be a relationship and a close relationship. A cousin wouldn't cut it.
So would you say that if there is a group of friends who are looking to purchase a property together, let's say 2 or 3 parties at the same time, they can actually go on the loan, like all 3 of them, contingent their credit is good and their income is good, and they can actually get a loan for one property between, let's say, the 3 of them or the 2 of them? Would that be correct statement?
Now, your office currently has a transaction that we're working. There's 4 people going on one transaction, and it's a conventional loan, so it's okay. They're not related. So yes, we have a similar situation. The underwriter will be pulling her hair, but yes, there's 4 people qualifying for one loan. It's conventional.
And like from your experience, David, is there a cap of how many people can be on the loan application? Because with
Well,
the affordability crisis right now, it
well,
seems like we need the village to buy a house.
we're talking theory. As far as I know, there is no limit, but you're not going to have 15 people apply for one loan, because that's problematic. Those people at some point will come in and there will be disputes. Get this off my name, refinance this. You're going to say rates are high, I cannot refinance it. So that's not realistic. We just got a final approval this morning on a loan where it's the son in Nevada and mom and sister in California co-signing for him. 3 people, 3 separate applications. 3 separate sets of conditions for each. There, we got lots of calls from the underwriter. That was a tough loan to get approval for. So 3, 4 would be as high as I have seen. Yeah.
So just a heads up, it is doable, but everybody needs to be ready and prepared for the process to be a bit more complicated and a bit more tedious. If you're trying to involve more than 2 people onto the one mortgage application, and especially if those people are not related, just expect that there are things on the other people's credit that you might not be aware of, correct? And that that there will be hurdles that you will have to overcome, and everybody has to be on board to be able to overcome it.
What happens is, and I talk to people, clients will quite often ask, David, what happens is if I bring in a co-signer, because we want to close the loan. We have an interest in closing the loan. We have an interest with the agent to make sure this transaction happens. But I'm going to caution you, if rates don't drop when you think they will drop, and you can refinance and your income and credit will be enough to be able to qualify for this loan by yourself, this person quite possibly will come in a year or 2 or 3 and demand that you take them off the loan. Maybe they want to buy a house. Maybe they're getting divorced or getting married. There's so many things that can happen. And for that reason, be cognizant of not what you want today, what's happening today, but what's going to happen, what may happen if you bring someone else onto your loan and make them a co-owner of that property.
So let's talk about those people who actually extended their graciousness and extended their credit to their friends or relatives, let's say, years ago, and they co-signed for somebody, and now they're wanting to purchase a property, or they're in the position of income where they can buy the property for themselves, but they are actually co-signers on somebody else's loan. And they're coming over to that person, and they are asking them to refinance. And of course, the person does not want to take them off the loan and refinance because they have like
maybe they can't
interest rate. Maybe they can't. So is there a solution for me? Can I prove that I'm not responsible for that payment, that I'm not the one making the payments? Is there a way out for me? Because yes, my name is on there, but I don't live in the house. I'm not making the payments. Like, how can I kind of like excuse myself?
So there's 2 things I can think of. And again, this requires proper planning and coordination with a loan officer. Number 1 is contingent liability. So if that's not your liability, and we can prove that this buyer, this co-signer, has not made payments, but rather this other person has made 12 payments. 12 is the magical number. 11 will not work. 12 payments from their account even though it's on this cosigner's credit history, it becomes a contingent liability. We can ignore it. To make the file even stronger, I would go ahead and suggest this person to show this as a rental income on their taxes. So to show enough income to offset the expenses, because now this cosigner has whatnot, interest deductions and property tax deductions, maybe show some income where that kind of offsets the expense, offsets the income, and that it's not eating away at your debt to income ratio. It's not adding another liability. It's a bit more involved. You may not have to do that, but that's something, again, you're going to have to plan with your CPA and your loan officer to make sure it doesn't hurt you.
So in terms of if you turned out to be cosigner for somebody's mortgage, make sure that whoever you cosign for, first of all, is definitely making their payments and is never late on their payments.
Oh, yeah.
Because let's talk about the liability of co-signing, because it is not just lending your credit. There are circumstances in the people's life when it can backfire at you, and I think that it is very important for us to talk to our listeners about the ways how it can backfire at you. We just named one that it might affect your ability to borrow in the future. What else can happen?
Oh God, number of things, Alexandra. So yes, the number one thing is for the cosigner or the person who bought this and you trusted them, you helped them out, doesn't make the payment. So your credit is ruined, okay? Because cosigner means the bank, you're equally liable for that debt. I've seen countless occasions where, and it doesn't have to be a mortgage, it could be a car too, that the people haven't made the payments. Another problem that comes to mind was I've had situations, and I can think of a very nice gentleman. He came in, he wanted to refinance his house. He bought the house in 2004, almost 20 years ago. That house has appreciated so much. He bought it with his brother. The brother helped out this person so they could, as a co-borrower, so they could buy this house. They're brothers, they trust one another, and they bought this house. Now the gentleman came in, he's like, I have a daughter, I want my daughter to refinance this house into her name. We started the refinance process, but guess what? The brother's married and the brother's wife has to sign off on this. The brother's wife sees a $300,000 equity on this house and doesn't want to let it go. And that was a big family feud. And this person, even though the agreement was almost 20 years ago that it's his house and the brother is only co-signing to help him to buy this, and he wanted to give his house, the $300,000 house, equity to his daughter, he still cannot do it. The wife wants half of it. The brother's wife wants half of it. And yeah.
And I think
sad.
I think it is a very good point that comes across a lot of times, guys, and we deal with it at our closings a lot. Remember, guys, if you have more than one party and if the other party with you on the loan is not your spouse, be ready that your cosigner, your co-borrower, is going to have their personal life. They're going to get married. They're going to get divorced. And those spouses, we are a community property state, which means that those spouses will have the rights and will be able to claim part of those properties. So unless it is all documented, and one of the things that you can do if you know at the time of the purchase that your cosigner is married, ask the spouse to sign the quitclaim deed at the time of purchasing and record it all together. So this is number one way how to protect yourself. If, let's say, there are two borrowers and one of them is getting married along the way, if you hear of your co-borrower getting married, make sure that you approach the co-borrower once again and have the spouse sign the quit claim deed once again, because this question is going to come up, just like David said, sooner or later, and sometimes years go by, and you don't, like, you lose the track of what is happening, and like in 20 years that brother could have married like several times. So guess what? All of his spouses would be able to claim some interest in that house. So this is a very important subject, and that you guys need to discuss. And
as the famous saying goes, bros before wives.
Is that Armenian?
Bros before wives?
Yeah.
It's a very famous saying, yes.
I don't know. As a female, I never heard of it.
You haven't heard bros before wives?
No, I have not.
Yeah, there says bros before wives. Yes, that's, yeah.
I'll
Leo, confirm that
you.
there is a saying, bros before wives.
Well, this is not how it is written in the letter of law in the community property states. Hi, Leo. Yes, everything is great. And David, another question that came up. Thank you, Leo. Okay,
Bros before wives. It rhymes, yes.
I thought it was, yeah, I thought it was Armenian saying, but okay, I'll trust you guys as usual. But answer this question for me, please. This is also something that came up when actually trying to protect the property ownership from the spouses and from the outside factors. I had a few clients approaching me asking, can we get a loan under an LLC? So for the investment properties.
All right. So mortgages, traditional mortgages in our understanding, are given to human beings, and human beings are liable for it, and they sign for it. That would be, well, investment property, especially, that's conventional loans, right?
We're talking residential properties, correct?
Residential but investment. Yeah, residential but investment. It have to be given to human beings. Now, once you close the note and deed and everything, we can convey it into your LLC. We could record it into your LLC if you're doing a Fannie Mae conventional loan. If I'm doing some alternative doc portfolio loan, then yes, we can record the loan immediately into your LLC. Some banks charge a quarter point for it. There's no reason to do that. Close it into your name, then record it into your LLC. That's what I would tell my client to do, so you don't have to add an additional quarter point to your rate.
Well, I would caution my clients, when you guys close on your personal name, and then want to transfer your own property into your own LLC, I need you guys to be aware of one thing. This event of a transfer is going to trigger what is called transfer tax.
Transfer tax.
Correct, which is 0.5% of the property value. And there is a way how to avoid it, how to still do the transfer, not pay the transfer tax, and actually fit into the exceptions of among the transfers. I'm happy to consult if you guys need that help. I'm not going to
run it through trust. I know you're smart. You told me about the trust trick.
Correct.
That's very smart. Yeah.
You have to make an extra step, and but that extra step saves you 0.5%. So if that is something that you need help with, let us know, and we will give you the scenario how it has to be done in order for you to save the money. But just remember that. Same thing if you are taking the property out of the LLC and trying to transfer it onto your own name. Once again, that kind of an action is going to trigger the transfer tax. So before you before you get surprised with the big bill from the county, talk to us. We're happy to help. We're happy to explain to you and route you the proper way.
Everything that you and I discuss is going to boil down to talk to your friendly neighborhood loan officer. In you and I's case, that would be me and you as the friendly neighborhood realtor. In Leo's case, up in Glendale, California, would be Leo. But talk to your loan officer and plan these things out. A lot of people don't plan. Plan your taxes. Plan your assets. Plan your LLCs and your trusts. All of that. Everything's so interconnected.
Absolutely. And I would like to remind to all of our listeners that, guys, our consultations are free. You can see our phone numbers. I always post our contact information under the videos on Instagram and YouTube. So our consultations are free. Just give us a call, talk to us. We're happy to. Like, even if you are in the situation when you don't know what is the right move for you, like, we just had a situation earlier this week where our clients are not sure if they have to sell, if they can rent the property out, if they need to get a roommate, or if they need to downsize. So, and for those clients, when they are, like, it actually, like, warms my heart when we were the first two people who were who were on that text message where our client needed to discuss it, where our client needed to get an expert opinion so she doesn't make the wrong move. And I know that the client that I'm mentioning right now, she is the accountant for a big firm, so she's used to making those decisions with the professional help and with the professional consultation. But I encourage everybody, guys, it doesn't cost you anything to get an expert opinion. Make sure that you know the person or trust the person, or you get a good referral for a person who knows what they're doing before you follow their advice. But please refrain from going into the ChatGPT to make the decision, to make, and base your financial decisions off the information from the ChatGPT. That's all we're asking for you to do. Stop being irresponsible. Put a little bit more effort into your financial planning, into making your financial decisions, and look around. There are always people, always professionals who are ready to support you and actually provide you with their time and their expertise on an everyday basis.
Leo and I wish we could charge for a consultation, but we're not allowed to. So talking to us is free. And we encourage many people to talk to us.
Well, we're in the business of helping people, helping families, and yes, we do get paid for it at the end of the day, but the truth is we're here to help no matter what. And, if we can't help, we're also being honest about it and at least giving you the heads up on what you can and cannot do. Please, guys, we're always open for the consultation. I'm posting the contact information at the bottom of the videos always. And David, thank you so much for your time. We really appreciate you and all the guys in your office. We talk to you soon. Thank you for joining. Have a wonderful week.
Thank you so much, Alexandra. Thank you. I'll call you today. Be in touch.
Thank you.
Take care.
Thank you.
Bye.
Bye.